Let's bring in Ankur Crawford, Portfolio Manager and Executive VP at Alger. Welcome back and Happy New Year to you.
Happy New Year.
So you're a believer in this reopen? I put reopen in quotes because, I mean, you haven't been able to really believe in it.
I think we're already seeing it. I think there was a lot of false starts as we went through 2022. But now it's done. If you look at the statistics and some of the high-frequency data in China, it's showing you that they are reopening.
So there's no going back.
There's no going back.
And that's kind of the view. Look, I asked Dr. Scott Gottlieb about that, too, the very issue of if he's a believer in it, to which he suggested it's kind of too late to turn back now.
Yeah, I agree. And even socially, they told you how they felt about it socially. And I think President Xi has made his decision.
Some have made the call that emerging markets, because of this very reason, are going to outperform the U.S. this year. Are you a believer in that?
Well, I do think that when China starts to roll, it does pull along Japan and the EM markets, which are relatively depressed relative to the U.S. market. But there are companies that have exposure to all of those markets in the U.S. markets. So there are a lot of multinational companies that will get the benefit of those other nations opening up.
One of the areas, obviously, top of the list, casinos, because of Macau. And, those stocks have had fits and starts. They've looked good, then they look bad because you just don't know where the policy is going to progress to. Las Vegas Sands, one of your names.
That's right. And look, the thesis is quite simple. We have the blueprint of what the consumer does from when the U.S. reopened and from when the rest of the world reopened. That blueprint applied to China tells us that LVS in 2023 is significantly under-earning. In 2024 and even in 2025, you see earnings growth that excels the 2019 growth rates.
What about, economies that are open, but economies that are still slowing? And a consumer, if you're talking about, visitors to Macau, mostly from, I would assume from that part of the world rather than from, obviously, the United States. So how do you think about that issue?
Look, I think that the main impulse on LVS is the mass market in China coming and visiting the casinos. On average, the Chinese consumer, we expect, will spend 30 to 40% more per visitation as they come to Macau on this kind of revenge travel. And, so I don't think it matters that there's some countries that are open and some countries that are reopening. It's all about China.
I'm thinking another LV in your portfolio. That's LVMH.
Yes. So we've talked about LV before. And LV is a bit of an all-weather stock, and in part because it really is accessing the highest-end consumer. So the Chinese consumer, for example, has been, basically shut down in China, hasn't been able to travel. Usually what they do is they go to Europe, where it's a lot cheaper to buy LV and Christian Dior and all of the brands. And they buy it there and they bring it back to China. They haven't been able to do that. Given where the euro is relative to the yuan, it's 30% cheaper to buy these goods in Europe. We expect that as soon as they possibly can, they're flying to Paris,
buying the plane tickets,
and they're buying LV.
That makes sense. TransDigm is another one. TDG.
Yeah. So TDG is not exactly the sexiest of companies. They make seat belts for planes, little things for your tray tables, spark plugs for a plane. So all the innards of a plane. However, what is fantastic about this business is 80% of their business is sole sourced. They have immense amount of pricing power. And 30% of their business used to be Asia Pac, which is currently depressed. They guided 2023 to mid-teens type growth without the impact of a China reopen. So it sets up for TransDigm to have, an interesting 2023 and 2024.
Before I let you go, your thought on the U.S. market right now is what? I mean, everybody's obviously cautious.
Yes.
That's the underlying narrative around everything. And you have been because of Fed policy. What about now?
Look, I think one of the things that surprised me in 2022 has been the resilience of the consumer. And, had you asked me a year ago, I would have thought that the consumer would run out of steam sometime in the summer of 22.
Would have rolled over by now.
That's right. And now we're looking at the mid-2023 is when the consumer is going to run out of steam. And so if the consumer has more legs, this has been a highly anticipated recession. Companies are preemptively starting to roll back expenses and, cut and lay off their workers. So if we are, in fact, a little bit better on the top line, it will come through on margins. And so the strategists have put out these 180, 190 S&P targets. You know,
for earnings.
For earnings, one has to wonder if there's in fact a little bit of upside. And now it's not that, you know, you should be way bullish, but at the same time, it might not be as bad as people think.